Hi everyone. So today we're going to talk about Social Security benefits and some of the things that goes along with the Social Security that the government provides you when you retire. So the other day we talked about how you can plan for your own retirement with individual savings, whether it be an IRA, a Roth IRA, or with the help of whatever employer you have with 401ks and 403bs and company match savings account. So today we're looking at how the government helps you plan for your retirement and has money for when you retire. So as you know, there's many expenses with having a healthy lifestyle when you're not working. So the government has an insurance program that helps workers when they retire and provide assistance. So in 1929, when the stock market crashed, the United States entered a period of it was really, really bad. So there were lots of people unemployed, banks and businesses failed, and the elderly had trouble paying any kinds of expenses. So that led to the Social Security Act of 1935, in which an insurance program that paid workers benefits after they retired. So basically, you're paying the federal government to hold money and put it away for you so that when you retire, you have money being paid back to you. Okay? So the Federal Insurance Contribution Act taxes you to see your deductible from your paycheck. Okay, so then there's the old age survivors and disability insurance, an insurance that pays benefits to retired workers that help them meet their financial obligations, provides benefit to families of retired workers and disabled workers under certain conditions. Okay, and then Social Security benefits are based on the earnings over a person's working lifetime. The reduced benefits start as early as age 62. So technically you can retire at age 62, but you're not going to get your full benefits. People who were born after 1960 must wait to start collecting their full benefits until age 67, which is the full retirement age. Now that may change. Okay, right now it's 67, but it could go up and you could not get your full benefit retirements until you're age 70. So be aware that they can change it. And then there's the full retirement age, an age which a person receives full Social Security benefits. And again, that age is subject to change. All right, so let's take a look at some problems. Now, some of these are based on 2016 because that's the data I had. Some of these are based on 2020 because I was able to access that. So just make sure we read the problem to determine which one we're looking at. So we have in 2016, we have Jose had 2 jobs. He earned $73,440 working at a nursing home in the first 8 months of that year. Then he switched jobs in September and began working at a hospital where he earned $62,000. How much Social Security tax did he overpay? And the current rate is 6.2%. All right, so let's find out how much he paid when he worked at the nursing home. So the nursing home, was $73,440. And we're going to times that 0.062, which is the percentage. And we get $4,553.28. Now at the hospital, he earned $62,566, and we're going to times that by 0.062. And we're going to get $3,879.09. All right, so between the 2 jobs, he's paid, let's find the total. So we're going to take the 2 amounts, $4,553.28, and add the $3,879.09. So he paid a total of $8,432.37. Okay, now, how much did he overpay? Well, how much was considered overpay? Well, in 2016, Okay, the maximum an individual should pay is is $7,347. Okay, and that's set by the Social Security Administration. So he did overpay. So we're going to need to subtract how much he overpaid. Okay, so we're going to take that $8,432.37 minus the $7,347 that the Social Security Commission says that's as high as you can pay in. And we're going to get a difference of $1,085.37. Now, unfortunately, it's not like we're going to get a refund on that. Jose paid that in, he overpaid, and there's nothing we're going to be able to do about that. So he's not going to get any refund. He overpaid his Social Security tax. So that's why you want to make sure that you have the correct amounts going in. All right, so the Social Security Administration, which is the SSA.gov, has a website which is in your folders, and it talks about all different things about the Social Security Administration, how to apply for your benefits, retirement, things that change over the course of the time. So you have what is called retirement, disability calculators, and things like that. So you have what is called credits, and you have what is called your Social Security statement. Okay, so you definitely want to peruse through here, especially when you start physically working and seeing where your Social Security money is going, so that when you retire in 50 some odd years, that you'll be able to get that money for you. All right. Okay, so please make sure you peruse that website. Now, the Social Security Administration is a record of all the money. They have a statement that gets sent. You can have it sent to you. I have one sent to me once a year. And it's the record of money individual earned every year, which includes the number of credits. Now, what do we mean by credits? The administration had set kind of like a tally to determine when you can retire. All right, so you have to have so many credits to be able to retire with full benefits. So based on total wages and self-employment income during the year, the amount of earnings it takes to earn a credit changes all the time. Depends on what they decide. So this I was able to find in 2020. You must earn $1,410 in covered earnings to get one Social Security credit or Medicare working credit, and $5,640 to get a maximum of 4 credits during the course of the year. Now, in 2016, it was $1,260. So they've raised it about $250. All right, so people born after 1929 need 40 credits in their lifetime to qualify for Social Security benefits. So right now, if I'm talking about myself, I need these 40 credits, and so do you, to be able to qualify for Social Security. All right, so let's take a look at this example. So we have Fran here, requests her annual salary Social Security statement from Social Security Administration each year. She wants to check how many Social Security credits she's received for 2020. So let's say she's worked all year and earned $8,102 per month. How many credits did she earn in 2020? Well, let's see how many credits, how much money you get for 4 credits. So let's do 4 times the $1,410. Okay, 0,416. So that's $5,640 per month. Okay, so she has definitely earned her credits because the $8,102 is bigger than the $5,640. All right, so she definitely earned her 4 credits, so she will be able to retire. Now, your benefits are based on the highest 35 highest years of earning throughout your lifetime. All right, so there is a formula for benefits that it's 90% of the first $856 of your monthly earning. Okay. It's 32% of your monthly earnings between $856 and $5,157, and 15% of earnings over $5,157. All right, so let's take a look at how this is going to get used. So we have Marissa, who reached age 62 in 2016. At age 66, someone born in 1954, like Marissa, can receive full retirement benefits. Over her lifetime, she earned an average of $2,300 per month after earnings or adjusted for inflation and stuff. What is her retirement benefit? Okay, so notice this is going to be an average of your lifetime earnings. So we definitely want to make as much money so that we have a better average so you get more benefits. Okay, so what we're going to need to do is kind of like do this like a scale. So we got to do the $856. Did she earn $856 per month? Yes. So we're going to need to take 90% of that. So we're going to do the 90%, so 0.9 of $856. So that's $770.40. So that's what she's earning so far. Now, we've used the $856 of her average monthly earnings. So we have to take that $2,300 and subtract the $856 because we already used that. So that's $1,444. Okay, now we're going to take, that's going to be the 32% of that. Okay, so we're going to do 0.32 of $1,444. Okay, and that's going to give us $462.08. Now she is not above the $5,157. So we don't have to use that 15%. Okay? If you're above the $5,157 after, okay, then we're going to need to do that, but we are not over that. So we're going to take our two numbers here and we're going to add them together to find out her total benefits. So let's label this total. Okay, so 770.40 plus 462.08, and we're going to get $1,232.48. Okay, so that is going to be her monthly retirement benefit at age 66. Okay, all right. Now, suppose she doesn't want to go at age 66. She's going at age 65. All right, she decides to go a year early. What will be her monthly benefits since she did not wait until age 66 to receive her retirement benefits? All right, so here's a chart to show you that when your year of birth, you can retire at age 66, 55, blah, 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 blah. And then after 1960, you have until 67. So right now, we all have to wait until we're 67 to retirement at full age. Okay. If you start collecting Social Security before your full retirement age, your full retirement benefit is going to be reduced. Okay. And they use 0.5%. All right. So we're going to need to figure out what 0.5 is. Okay. So this is actually 0.56%. All right. So we're going to need to take 0.56% of each month before she retires. So she retired a full year before she could, because she did 65, full year is 66. So we're going to need to change, okay, figure out the percent per month. Okay, or per year for the year. All right, so we're going to do 0.0056, that's 0.56% as a decimal, She went out 12 months earlier. Now, she decided she was going to go at, let's say, 64. We'd be using 24 because that's 24 months before she was able to retire. So it's by month, okay? So once we do that, we're going to get 0.0672. Okay, so that is the percentage that she's going to be reduced. So this is 6.72% reduction, shall we say, in her benefits. All right. So now we're going to need to take her monthly benefits, which we found earlier as $1,232.48. We're going to find 6.72% of that, and then subtract so we can figure out her new monthly income or her benefits. Okay, so 1,000. Okay, so let's do new benefits because she retired early. So we're going to take the $1,232.48 and we're going to times it by that 0.067. And we're going to see a reduction of $82.58. Okay. All right. So now her maybe I shouldn't have labeled that new benefits. I would say, shall we say decreased by? Let's do that. Okay. So her new benefits would be the $1,232.48 minus the $82.58. So her benefits now are $1,149.50. Okay, so is working one more year worth the $82 a month? That's up to you. Okay, all right, so let's find a difference between her monthly benefit between 62 instead of age 65. All right. Let's say if she retires at age 62 instead of age 65. All right, so we're going to do this process again, except we're going to use age 62. Now, she's able to retire at age 66. So 66 minus 62, we have to figure out how many months that is. So 66 minus 62. Okay, that's 4 years. And there's 12 months in a year. So we're going to reduce this by 48 months. All right, let's see. So we're going to take that 0.0056 and times it by 48. Okay, so that's 0.2688. So we're reducing this by 26.8%. All right, so her benefit, 1,232. Okay, so let's call this her deduction here. So that's $1,232.48 times what we found here, 26.88. Okay, so $331.29. Okay, so her new benefit would be the difference between $1,232.48 minus the $331.29. Okay, I got $901.19. Okay, so that's a huge difference. Okay, so the difference is $331.29. So she's only going to make $901.19 if she retires at 62 instead of 66. I did 66 instead of 65. All right. All right. Any questions, guys? All right, have a great rest of your day. Please stay safe because we're going to try and keep everybody safe by staying in. Let's talk to you later.